Have you ever noticed how something can look completely stable right before it collapses? In 2007, millions of people in the United States and parts of Europe believed they were doing fine financially. They had jobs, they had homes, they had cars in the driveway. On paper, life looked successful. But underneath, the system was built on something fragile. Let's imagine a simple scenario. You're 28 years old in 2006. You just got your first real job in the USU, earn $60,000 a year. After taxes, maybe you take home around $3,800 per month. Your expenses look normal. Rent or mortgage, $1,500 car payment, $450 student loan, $300 credit card payments, $250 groceries, utilities, insurance, $900. That leaves you with a few $100s. It's not much, but manageable. Now imagine a bank says, "Why rent?" You qualify for a mortgage. They offer you a house worth $350,000. The monthly payment, around $2,100. They tell you not to worry. Home prices always go up, so you buy. This happened at scale. Banks started giving mortgages to people who couldn't really afford them. These were called subprime loans. Many had low teaser rates at the beginning. Payments looked affordable at first, but later, the rates adjusted higher. And here's the part that made it dangerous. Banks didn't keep these risky loans. They bundled thousands of mortgages together and sold them to investors as something called mortgage-backed securities. On the surface, it looked sophisticated, diversified, safe. But it was like putting bad apples into different baskets and pretending the baskets were healthy. At the heart of it was a simple math illusion. If a home worth $350,000 goes up 5% per year, people assumed it would always be worth more next year. That belief turned housing into a one-way bet. You can visualize steady growth like this when you look at a curve like that. It feels safe, predictable, upward. But housing prices don't move in perfect curves. Now imagine prices stop rising, then they fall. That $350,000 house drops to $280,000, but you still owe $340,000 on your mortgage. You're trapped. You can't sell without taking a loss. If your adjustable rate increases, your monthly payment might jump from $2,100 to $2,700. That extra $600 doesn't exist in your budget. Multiply that situation by millions of households across America, the UK, Spain, Ireland. People started defaulting. When homeowners couldn't pay, the mortgage-backed securities built from those loans also collapsed in value. Banks didn't know how much toxic debt was sitting on their balance sheets. Trust disappeared. And when banks stop trusting each other, the financial system freezes. Even strong institutions like Lehman Brothers collapsed. Stock markets crashed. In the US, the S&P 500 lost more than half its value from peak to bottom. But here's the uncomfortable truth. The crisis wasn't just about greedy banks. It was also about psychology. People believed homeownership equaled safety, status, stability. Owning a home felt like adulthood. Renting felt temporary. Banks believed housing prices couldn't fall nationwide at the same time. Investors believed complex math made risk disappear. Everyone assumed someone else had checked the system. This is called herd behavior. When everyone around you believes something is safe, questioning it feels irrational. But financially intelligent people think differently. They don't assume prices only go up. They don't buy based on what banks approve. They look at worst-case scenarios first. If your income drops by 20%, can you still survive? If interest rates double, can you still pay? During the crisis, people who had low debt and cash reserves didn't panic. They had options. The others had obligations. And obligations are heavy when the system tightens. The long-term impact? Millions lost homes. Retirement accounts were cut in half. Young graduates entered a job market with hiring freezes. In parts of Europe, unemployment soared above 20%. But something else happened quietly. Generation became more cautious. The real lesson of 2008 isn't don't buy homes. It's this. When growth feels guaranteed, risk is usually underestimated. When borrowing feels normal, leverage is usually too high. And when everyone says, this time is different, it rarely is. The crisis wasn't caused by one villain. It was caused by optimism, easy credit, and a belief that prices only move up. Understanding that makes you calmer, more skeptical, less reactive. And that's the mindset shift that protects you long before the next crisis ever begins. If this explanation helped you see the system more clearly, consider subscribing for more calm, realistic breakdowns of money and markets.